Hey there, welcome aboard. It's Walter here. Glad to have you here. Losing my voice a bit here, but I just wanted to share with you a quick idea that I think is going to help your trading. So we're going to talk about this in the big account and the small account big profits course. You can click the link below or above if you want to get in on that. But essentially, the idea that I want to share with you is about your testing. So when you're testing your strategy, a lot of times what people will do is they'll say, oh, it would have made this amount of money, so I'm going to go live with it. Um, and I think one way of looking at the outcomes or potential outcomes for your system, which is a little bit different to what most traders do, is to approach it from this point of view. Instead of saying, oh, it would have made 180,000 and I would have had a drawdown of 25 grand or whatever it is, look at the drawdown in terms of R. Now, R is simply the amount at risk on any given trade. So if you keep the amount at risk constant, like my friend Mark does when he does his back testing, what that does, like for example, $100 a trade, what that does is when you see first of all, you see if the system makes money, number one, because sometimes by tweaking the risk management rules, a system that's not very good can actually look really good and can look better than it is. So that's number one. Number two is when you do this, it's important to remember that you can now gauge your drawdown, your losing streak, your worst losing streak in terms of R. And that's a very valuable measurement. So let me give you an example. Let's say that you have an account or a trading system and you're trading that system and it turns out that that system took a $10,000 account up to 150,000 over your testing. Well, here's the thing. What happens if the drawdown is 15,000, and if you're risking $100 on every trade, and your worst drawdown across that time period is 15,000, then what does that mean? It means your worst drawdown was 150 R. Now, a lot of people would have a difficult time trading through a 150 R drawdown, and so that's the important point here. We're going to talk about this in the small account big profits course. You can click the link below or above to get more information about the course. But the important thing here is that your drawdown can be viewed in terms of R. So in other words, it doesn't matter how much you risk. Whatever you risk on any given trade can be seen as you take that amount and you multiply it by the number of R drawdown. So if you have a 150 R drawdown and you're risking 1% per trade, that's a pretty significant drawdown, isn't it? So that's what I would encourage you to do. When you do your testing of your strategies, definitely look at your returns in terms of R. And the way that you do that, or a simple way to do that, is to look at constant risk. So use constant risk across the board. And then finally, when you're looking for the deepest drawdown, calculate it out in terms of R. And that will, now you can know, okay, well, this is the worst case scenario. You might see something worse when you actually go live, but at least you have an idea of what to expect, and you can adjust your risk based on that, assuming you're using fixed fractional. So I hope this helps. If you want to join us in the class, you can click the link below or above for small account big profits. I'll see you soon. Catch you later. Bye.